Welcome back. You're still watching Finweek Money Matters. Don't forget, this is the show that helps you manage your finances. Buoyed by the results of the Brexit referendum on the 23rd of June, gold has risen to levels last seen 8 years ago. Gold miners have taken advantage of this upswing, cancelling or restructuring debt, and in some cases even paying dividends. But will the metal's upward trajectory continue? Joining us from our studios in Cape Town to discuss this and the outlook for the gold price and gold mining companies, I've got Peter Major, Director of Mining at KD's Corporate Solutions, and Andre Rousseau, Portfolio Manager at Investec Asset Managers Management. Gentlemen, thank you so much for joining us this afternoon. Peter, maybe let me start with you and talking about post-Brexit, that gold price 8-year highs as we've been hearing, volatility that we're currently seeing. Do you think that this can be sustained?
No, I don't. Volatility almost never gets sustained, whether it's a world war or a typhoon or a global financial crisis. Human beings are like ants. You can stir up the nest and there's a lot of pandemonium for a while and then they get to work rebuilding it. So no, I don't think the volatility will be sustained. I think that's what shot gold up so much the last 2 weeks. But I think these very low interest rates around the world that are now forecast to stay low, which means zero for the next 2 years, I think that will keep gold up around 1250. But 1350, no, I think that was just the volatility that kept it there.
Andre, as Peter is saying there, volatility is only really short term, it's not going to be sustained. Investors at the moment are on the hunt for yield, one would think. So in the longer term, what are you saying to your clients? Are you saying maybe those gold mining stocks are where to start putting your money?
Yeah, certainly, and we're seeing more and more money getting thrown at gold, at physical gold and gold equities. And I think listening to Rupert, the previous speaker, talking about diversification, that's the only free lunch that there is in the investment world, is diversification. And what we've just seen, whether you believe gold should be 1250, or there's a lot of the big banks are now pushing for 1400 or 1500 gold, if you believe gold's going up. The one thing that's been clear is that gold is a key diversification that you can get in your portfolio. That's uncorrelated with other asset classes. We've seen gold now up 28% this year compared to the FTSE, up 5, S&P I think gave you about 2, and the JSE all shared just about 1. So it's the uncorrelated returns that gold offers at the moment and certainly offers over the long term, is going to continue to drive more investment into gold, and it effectively becomes an insurance policy against continued uncertainty in the world and continued low yields.
Peter, looking at gold mining companies, I mean, we've seen them certainly taking advantage of the higher gold price, generating free cash flow. Can we draw the conclusion that we'll probably be seeing increased dividends coming from these gold companies, and therefore, again, here's another reason to be invested in them?
Look, we're definitely going to see increased dividends because most of them haven't been paying dividends. So when your revenue goes up 35%, literally overnight, literally in a few months, 35% more revenue, it'll take your costs a couple years to catch that. So all of a sudden you've got a lot of cash that you never planned on, never dreamt of, that you haven't had in a long time. And so there's so many uses for that cash, especially if you're a South African gold mine. You probably have huge debt. You probably haven't spent hardly any money on capital expenditure or development. So there's more than enough good areas to spend that money. And yes, it would be nice to pay dividends to shareholders if you have the money. So I think they're going to do a bit of a spread. They'll pay down some debt. They're going to do some real needed capex. They might do a little more prospecting on extending their lives longer. And they'll score lots of brownie points paying a little bit of dividends, especially to some of the institutional shareholders that need that money. Look, it's a windfall. And windfalls should pay much higher dividends than normal, and we didn't see that the last 10, 12 years when we had some great windfalls. So I think they'll try and make up a bit this time.
Andre, so we're talking about diversification. We've been speaking about holding or being exposed to gold by the form of maybe investing in these gold mining companies. Let's talk about other forms of holding gold. So the physical metal in itself, like your Krugerrands, should we be looking at ETFs? What would be the best in for an investor right now?
So to me, there's three obvious ways to invest in gold. Firstly, as you point out, physical gold, and you can buy that through a Kruger coin or physical gold. Of course, then you've got to take into account the risk and the cost of keeping it safe, whether you keep it safe at home or pay a bank to keep it safe for you. Secondly, obviously, you can buy the ETF. It's a physically backed paper product that is insured effectively by the banks. And then thirdly, you can invest in the companies that actually produce the gold. And as we've seen now year to date, the benefit that these companies have are actually kind of more exaggerated in the fact that there's an operating margin, and that offers you much higher returns in an environment where the gold price goes up. And we've seen this in previous bull markets where the equity significantly outperformed the physical investment of gold. So just illustratively year to date, as I said, the gold price is up 28%. If you look at some of the key tickers, Harmony's up about 300% this year. Sibanye Gold, Anglo Gold, all gave you more than 150% upside this year already. And I've got to say, you spoke about the cash flow generation. These companies are producing significant cash flow. We're talking about cash flow yields of 15%. We're talking about PEs single digit. So these are not expensive equities at the moment. These are still offering good value.
Peter, I want to pick up on the point that Andre just made and you made before about if you're sitting with this cash flow, you said they hadn't been paying dividends, so you can expect that. In terms of M&A activity in this particular space, what can we expect?
Oh, man. I don't have an easy answer for that. Look, there's always need for M&A. There's always mines that are really struggling, that if they had a little bit of backing, a little bit of money, some management expertise, they could do well. And South Africa is a great area for M&A, not just because of the BE requirements, but because we got 6,000 abandoned mines. We got more ore, viable ore, than probably America and Russia put together. So this should be a great environment for M&A. It's not a great investment environment. It's not a great economic environment. And if we can get government to help us tweak those a little bit, under the present circumstances, on a macro view, it's a great M&A environment. Interest rates have never been lower. They're going to be at zero for another 2 years. The world is sloshing around cash, and we still have 50% of the world's gold. So there's definitely going to be some M&A here, but nothing like there could be, nothing like there was in previous times. So government should see that as a real opportunity. They should be coming to the plate and saying, guys, we got half the world's gold. There's trillions of dollars looking for a home. Tell us what we can do to get some of that money here for the country, like Zambia, Zaire did during the copper boom.
Andre, I just want to finish off with you. I remember, I think it was either the beginning of this year or last year sometime, you'd put out a note regarding the price of platinum. And I know we're deviating slightly from gold here, but just to do a quick comparison, I mean, at the moment, we do know that it is a wage negotiation season. Platinum's back above that 1,000 level. Just your analysis on gold versus platinum at this point. Interested to hear what you think.
Sure. No, the fortunes of the two obviously are closely tied together. Both have the key element of demand as being investment and jewelry. In that sense, we've seen platinum now also recover alongside gold. So the discount to gold slowly starting to narrow. We've seen that discount spread. So if you look at the gold price versus the platinum price, platinum was as much as $300 an ounce cheaper than gold, which is not normally seen. Normally platinum trades above gold. If you go to the jewelry store, they'll probably charge you more for a platinum ring than for the same gold ring. So we're slowly seeing some benefit from investment demand in gold factoring through into platinum. What we really need to see in platinum is a recovery in demand. We're seeing auto sales numbers slowly ticking up in Europe. US numbers are still reasonably strong. And then of course it's this big question of platinum stockpiles and whether we are working through it. And I think most analysts would agree that we are now entering into a deficit in the platinum market. And if I do see these storm clouds on the horizon about potential strikes and a difficult wage negotiation, we could see some further upside in platinum also this year.
Gentlemen, thank you so much for joining me this afternoon. Always lovely to have you and get your insights. A very big thank you to Peter Major, Director of Mining at Katie's Corporate Solutions, and Andre Rousseau, a Portfolio Manager at Investec Asset Management. That's where we leave it for Finweek Money Matters, but don't forget that you can go and get yourself a copy of this magazine. It is available at your nearest store, or if you don't want to do that, you can go online and have a look at some of the discussions that we have had. Well, until next week, have a fantastic weekend.